All right, what's going on, everybody? It's your boy Crypto Wolf back again, and just doing a little quick video here talking about a lot of articles and news and quotes that came out today. Everybody was talking about the CPI numbers, and just wanted to do a quick little rundown. If you don't know what is up with that, it is the Consumer Price Index, and numbers came out today. And so I'm going to run through a quick couple little charts over here, but this is the main one here. This is the US Consumer Price Index. As you can see, it is absolutely ridiculous, skyrocketing. If this were Bitcoin, we would all be partying like it's the end of the world and buying Lambos. So, or in my case, maybe a Ferrari. But obviously, if the price index represents, a general average, maybe, if you will, of what things cost, going straight up and to the right is not the direction that we would want to see it. And this is a weekly chart right here, but you can see, even just on this window, it's going all the way back to 06. If I zoom out a little bit, it's stupid. It's, it never really flattens out. We have a couple little pullbacks here and there, but generally speaking, it sucks for everybody else who's not pretty much rich. So, and it probably sucks for them too anyways. So that's the regular consumer price index, but we also have this guy here, which is the core CPI, and it says year over year, so I think it's, the actual year over year difference number. And as you can see, there's a little bit more ups and downs to it, which kind of, you could almost think of it like a more accurate representation of what it's doing right now compared to what it was. So like here, it was going down a little bit, it's going up a little bit. It's not necessarily that the actual CPI wasn't going up, it was just maybe going up less. So kind of, it's a little easier to look at. And you can see right here, just the big dip right there, May 2020. And since then, to the moon. Now it does look like, potentially could be rolling over a little bit, going sideways. We shall see. Getting the numbers back today, and pretty much every time recently, it's been worse than they expected. It's kind of interesting just to see Market Cipher on some of these charts, because hey, if it's on TradingView, Market Cipher will run with it. And just kind of looking at this, just for fun here, RSI just pegged to the red line right there, maxed out. Are getting a VWAP cross to the bottom, so who knows, maybe potentially we swing back a little bit here. Fed has been raising rates, but nobody really expects that to help us, at least at any point in the short term here. And that's what I'm going to jump on right now. So there was a pretty good article that I read while I was on lunch today over here at Zero Hedge. A shocked Wall Street reacts to today's scary CPI print. I'm going to go through this a little bit because there's a lot of good stuff. I'll skip over some of the quotes at the end and just read a couple, but here we go. So it was a CPI report for the ages, with most already expecting a hotter than expected print, thanks to JPM. That's precisely what they got, and then some. First, a quick recap. Headline CPI prices surged by 1%, 0.97% unrounded, month over month in May, beating consensus expectations of a 0.7%. So, 30% more. Energy prices spiked 3.9% month over month as gasoline prices reached record levels and food prices increased 1.2%. Year over year headline CPI inflation made a new 40-year high of 8.6%. That's going to be the big one that you're probably hearing about on the news and wherever you might catch information. And you can't really see this chart very well, but US CPI, urban consumer, month over month, year over year. So month being the green, dark one here being the year. This little red gap right here showing you going all the way back 40 years. A chart showing the annual increases in all segments shows that just two things in the entire CPI basket are cheaper compared to a year ago: food at employee sites and schools, and education and communication commodities. Yeah, two things that nobody really even cares about. Meanwhile, fuel is up more than 75% year over year, but I'm sure anybody watching already knows that. This guy here is basically just a little heat map that is showing, I believe, is this month over month? I think it's, yeah, month over month. So the darker red here is showing a larger increase, and these little bluish purple ones are actually decreases. And if you look down here, it shows you the weight that these various categories go into the main one. I don't know, let's see if you can see that a little bit better. And you come down here to the two that were doing a little bit better. It's 0.09% of the whole of the weighted average, 0.49%. So yeah, basically nothing. The only thing that's lower is food from vending machines and mobile vendors. I mean, who gives a crap about that, really? So as you can see, pretty much every single area that they're measuring is higher. And up here at the top, fuel oil and other fuels, motor fuel, utility pipe gas service, meats, poultry, fish and eggs, transportation commodities, aside from fuel, other food at home, non-alcoholic beverages, electricity, dairy, cereals, bakery products, everything going up substantially. And, you know, some of these numbers, right, you're seeing, like, jump back to it real quick, just show you 75, 49, 30. I mean, bananas. Core CPI also beat expectations. That's this guy here that we were looking at, rising 0.6% month over month versus consensus at 0.5. Consensus is basically what they projected. The year over year rate dropped from 6.2 to 6% because of base effects. Not entirely sure on that one. Basically, it just seems like a year ago we weren't looking so hot either, but potentially maybe a little worse. You can just see just spiking right up here in the last couple of years. Headline inflation was largely driven by energy and food amid the soaring food costs. Chicken, eggs, milk, and cupcakes all screamed higher. Trying to hit me on the cupcakes, man. I hate it. In fact, food contributed 0.16% of the 1% month over month. The size of the box below represents each component's contribution to food, and the color of the box shows month over month percentage change in price. Eggs were up 5% in May. And you can see these dark red boxes. I don't know if we can get it to where we can read it better, but dairy and related products down here. So a lot of dark red over there. Poultry, chicken, eggs, carbonated drinks. So your pop or your soda pop, however you want to say it, is up. Can't really read down here in the bakery products, but it's not doing much better. And as we come down here, so the strength in core inflation was across the board. Core commodities rose 0.7% on the back of 1% and 1.8% increases in new and used car prices, respectively. Along with the sharp drop in auto sales last month, plus supply has been ridiculous on that one. This suggests that the auto industry was hit by a fresh bout of supply shortages last month. Okay, made my point. Meanwhile, apparel prices increased 0.7% and other goods were up 0.8%. So, I mean, it's basically, we're getting hit everywhere. And so I'm going to skip some of this guy here. Last 3 months alone, airfares have risen 48%. Although some, if not much, of this strength is likely to reverse in the coming months. We'll see, hopefully. Bank of America's economists recommended that investors keep an eye out for the Cleveland Fed's release of trimmed mean and median inflation. I doubt it's going to have much effect on sentiment, or at least in a good way. What is even more striking about today's report is that Bank of America's Adetua Bave, sorry if I butchered that, writes, stepping back is the fact that there were almost no pockets of weakness in this report. And indeed, Breen writes that 61% of the detailed CPI components are seeing price gains over the last year of 6% or more, down only slightly from April's 63%. The data are consistent with the increasingly popular view that inflation is no longer just a function of goods supply chain disruptions. You don't say. I mean, we've only been saying this, for, well, technically we've been saying it for years and years, but specifically since all the spending kicked off in earnest. Inflation is also being driven by strong consumer demand because of a red-hot labor market and strong wage inflation. Yeah, I'm not seeing that one so much, but I'm not saying it's not possible. Accordingly, inflation has become embedded in the more cyclical service sectors example housing as well. In fact, as shown below, while goods inflation dropped to only 1.7 in year over year, the lowest since last September, services inflation is the highest in over 3 decades, contributing to 3% of the 8.6 year over year. Let's see if, holy smokes, zoom out on this guy a little bit. So, and just showing the in relation to each other, you got goods, services, food, energy. So it seems like obviously energy's getting worse. Services kind of been the biggest kick lately. But the next chart shows the problem for policymakers posed by diverging headline and core indexes. While the contribution from used cars and trucks is starting to dissipate, shelter continues to push higher. And this one has just gotten absolutely crazy. Uh-oh, there we go. Trying to make this a little more visible here. Just as we said it would about a year ago, even though it's only a matter of time before soaring rents and mortgages bring prices sharply lower. Hopefully, but we'll see. And speaking of shelter inflation, it surged almost 5.5% year over year in May, up from 5.14 in April, and the highest since 1991. As for rent inflation, it jumped over 5% in May, up from 4.8 in April, and the highest on record. I know, I actually just, after hearing, because a buddy of mine was doing some house shopping lately, and I went up and looked to see 3 years ago when I was looking for, like, apartments and condos and stuff like that. I went back to those exact same places just to see what the prices were after hearing from a couple people that had gone crazy, and oh my gosh. I mean, places that were like 930 something a month were up to like almost 1,300. The places that used to be like 1,300 were up anywhere up to like 2,400. So, and I'm not in a downtown area, so crazy. Let's see, all other items in the core index taken together have at least stopped increasing on a year-over-year basis, but food and energy inflation continue pushing new highs. Below is the heat map of CPI on a month-over-month basis. Slightly different, but fairly similar year-over-year. What happens next? Well, the Fed has telegraphed 50 basis point rate hikes in June and July. Its next decision point is in September. Bank of America writes that although its base case remains a 25 basis point hike, today's print increases the risk of another 50 increase. Meanwhile, the market is pricing a more aggressive Fed response on the back of today's print. So basically, the market is pricing in the fact that they are likely going to have to raise rates further than they say they want to. Even here, assigning probability at 75. I'm going to get to some of these interesting quotes just below here, and it should give you a better idea of what people actually think. I'm just going to skip all this about points. Doesn't really matter. So here, from Goldman's. In our view, the broad-based strength in core inflation tips the balance for the Fed to continue its 50 basis point per meeting pace of tightening through September. Continue to expect a terminal rate of 3 to 3.25. Yeah, maybe. I remember there being some interesting ones down here. So let's see. Called on Biden to lift tariffs to ease price pressures. While the Federal Reserve continues with its long-term strategy to stem inflation, we need the administration and Congress to move forward on steps to lower prices that can be taken immediately, which they are already doing, trying to repeal tariffs on Chinese goods, which I think at the same time we're kind of forgetting why those were in place to begin with. But what do I know? At the same time, prices going down on goods is one of those things that you rarely, if ever, see. Like, even after the fact, like, even if all this inflation stuff chilled out, like, I barely have any expectation whatsoever that prices on things would go down. Now, gas, because it's a little, faster reaction time on the price, but, for other things, maybe food would, have a little bit quicker reaction, but durable goods, all that stuff, when the hell do we ever see that stuff go down? Stronger than expected inflation data pushes out the time frame for peak inflation, right, and it gives the Fed the green light to continue with their aggressive tightening policy. I'd also note that the drop in the 10-year yield on this data and the flattening of the yield curve is a signal that markets are seeing stagflation as an even bigger problem. People are finally accepting what's going on. And not only that, but people from these large institutions and firms are actually talking about it and putting it out there. Whereas, you know, generally speaking, in the past, you just wouldn't see it. They just kind of, hey, you know, everything's okay, everything's fine, we're gonna be okay. Oh, they just gotta raise rates a little bit, you know, it'll be over, it's transitory, blah 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 blah. You know, typically speaking, it's, you know, don't rock the boat. But let me see, there was a really good comment, probably got pushed all the way to the bottom by now. But yeah, it's just, at this point, just the fact that everybody is not only accepting and realizing what's going on, but the fact that, you know, people from Bank of America, Goldman Sachs, you know, Chase, like all these big firms are saying basically the same thing that, you know, people that are even commenting on this site have been saying for a while now. It's like, okay, everybody realizes that it's not going to be over probably anytime soon. Let's see here. Actually, I know what I can do. Nope. Oh, come on. There's got to be more. So basically, this guy was... I can't find the comment. I probably got pushed way off by this point. But he was talking about how... Now, back in the day, I think it was when Volcker... This guy seems to be talking about it a little bit too. But back when he was head of the Fed... and they were dealing with some large inflation problems, they actually raised rates up to like 20% to finally kind of kick inflation back down. And keep in mind, I mean, we're struggling to get above like a couple percent, like a few percent. And at the time, the debt to GDP ratio was like 30 something percent. Right now, we're almost at 130. So it's a very different animal. And if they really wanted to get rid of it, it's going to be like a ripping the band-aid off kind of situation. There's no easy way out of it. It's going to suck. It's going to hurt. And I get the impression, and so do a lot of other people, that they don't want to do that. You know, they're trying to tiptoe around it. They don't want to cause a gigantic shock to the system, to the market. And to make a gigantic raise in rates would absolutely do that, but at the same time, realistically, it's probably what's needed. So it's, you know, damned if you do, damned if you don't. At some point, though, you know, in order to get back to like a healthy market situation, it's going to take some pain. Now, obviously, myself, and I'm sure anybody listening right now, doesn't want that right now. You know, we'd love to kick the can down the road, procrastinate, you know, push it off a little bit longer. I know that, you know, I'm not quite in the best position to, you know, ride out some kind of wicked, I'm not even going to call it a bear market, just a wicked market. So, and a lot of people aren't either. And the last couple of years has not put people in a good position to weather something like that. So, you know, what do you do? You know, what do they do if, you know, you're trying to solve the problem, but you know the only real way to solve the problem is to basically kick everybody in the nuts. So, who knows? But all I can say is, you know, they were saying that their prediction was, you know, they're going to keep nickel and diming with the rates, and eventually we're going to reach a point that, you know, if we can't pull out of it over the next year or two, where things will get rougher, and at some point they're going to say, okay, well, you know, okay, it's gotten too bad, we got to back off and go back to a little bit of like quantitative easing, lower the rate back down. Whether or not they'll you know, bounce back and forth after a little bit and try to, you know, get some balance while not just leaving it at zero forever. Who knows? But we shall see. But over here, looking at Bitcoin, 15-minute, getting some big spread on the RSI right there. Money flow is coming up very close to the zero line. You know, momentum working its way up, having a general trend to the upside. It is Friday evening, it's the weekend, and we are pretty much right on a resistance level, so we'll see what happens with that. I'd say we definitely have some more potential to the upside, but man, that spread is a little rough right there. That's the biggest RSI spread we've had since back here, but that's actually a good example of what I wanted to point out. So even though we had a wicked RSI spread right here, a lot of bullish action just pushed it up, like that money flow coming up, a lot of people jumping in, gave us a nice little pump to the upside. Whether we'll see that on a Friday night, I don't know. But the money flow is in a good spot for it. I mean, we could cross and start heading up to the green if we got some nice retail action going. Looks like it may not be the case right this second, so keeping an eye on it. Yeah, Ethereum, you could see looking quite a bit worse. Quite a bit worse. Yeah, ADA Polkadot, not too terrible. Solana, not too terrible. And it looks like ETH's doing rougher than everybody else. It's kind of interesting. But real quick, just jumping on this other article, and I'll leave links in the description if you actually want to read through this stuff. I mean, I know it's fairly boring, but at the same time, just getting an idea of where the market's at kind of helps you to plan ahead, which is kind of the whole point of this. Is if you have the expectation that things aren't going to blow over soon, if it's not going to bounce back and we're going to be back in a bull market and everybody's happy, everything's pumping, everything's doing great, all you got to do is just dump your money in the market and it'll appreciate. If that's not the case, then you need to prepare yourself a little bit. You need to try to find things to do with your money that A, is not just going to have it sitting there losing value, B, sitting there not gaining any value, which is almost just as bad. But at the same time, realize that, hey, if prices are going to keep going up, you got to keep that in mind. Whether it's cutting back on some unnecessary spending or whatever it might be. Keep that in mind. If if you're making it through okay right now with the prices the way they are, maybe save a little bit, maybe try to put it in something that's going to hold value a little bit, something fairly liquid that you can get it back into cash if you need it in an emergency. But don't just keep spending like it's going out of style right now, knowing that in the fairly near future you may be needing that money and wishing that you didn't blow it on some dumb shit. So keep that in mind. But red hot US inflation no longer an outlier, so it is not just the US, we are seeing it all around the world. Global year-over-year inflation logarithmic scale with selected countries annotated US inflation absolutely high, but no longer an outlier. Inflation is truly global. So, all my people watching from other countries, I feel you. We're in the boat with you. Venezuela, Zimbabwe, obviously those guys are going to be practically off the chart. Lebanon, Turkey, Russia up here. We'll see what happens with the currency bouncing back a little bit. Maybe they bring themselves back down from the brink. But with everything going on and all the sanctions and all that, expectations are kind of mixed. Brazil a little high, UK a little higher than us. Eurozone floating around the same range. Interesting that Italy is down here. I'd be curious where Greece is at this point. But interesting that China's down here, down the bottom of the map. I wonder who these four practically no inflation countries are. Curiouser and curiouser. But that's it. I'm not going into reading this thing very much or anything. Just wanted to say, hey, you know what? Look at this. There's where Biden got in office. Boom. Yep. Is it a coincidence? I don't know. I don't believe in coincidence. But I'm not a detective. But I still don't believe in it. But that's what's going on with everything. I don't know. It probably wasn't all that interesting. It's just everybody's been talking about it, so figured I'd touch on it because I'm still doing a little bit of work on a more official looking video. So I at least wanted to put something out. Just look at the chart, see what's going on, force myself to stay involved and active and all that good happy horse stuff. But all right, I'm cutting it. You guys have a wonderful weekend and should have something interesting this weekend. We'll see. It depends. It's going to be hot as all hell outside, so not sure if I'm going to be doing a whole heck of a lot. At least out there, other than the morning. But later.